There's a retirement mistake that looks responsible from the outside, but can quietly cost you some of the most valuable years of your life. You spend decades building a $1 million portfolio, finally reach retirement, and then become afraid to use it. You keep the thermostat lower, postpone the trip, delay helping your kids, and tell yourself, maybe next year. But here's the problem. Retirement is not just about making your money last. It's about making your money useful while you still have the health and time to enjoy it. And today I want to show you a smarter way to think about retirement spending, one that balances income, taxes, market risk, healthcare, and the simple fact that your priorities change as you get older. Because the goal isn't to die with the biggest portfolio. The goal is to get the most meaningful life your portfolio can reasonably provide. The first mistake is assuming your retirement spending should look exactly the same at 62 as it does at 82. It usually won't. Early retirement is often when your energy, mobility, and curiosity are highest. You may want to travel, renovate the house, visit family, pursue hobbies, or finally take the trips you postponed during your working years. Later, your lifestyle may naturally become less expensive. You might travel less. You may drive less. Some hobbies may disappear. You may spend more time at home. Then much later, healthcare and support costs can become more important. This creates a crucial planning insight. Your retirement budget should have a timeline, not just a monthly number. Instead of asking, how much can I spend every year? Ask three different questions. What do I want to spend while I'm highly active? What will I probably spend when my lifestyle slows down? And what financial resources need to be reserved for potential care later? That changes retirement planning from a single withdrawal percentage into an actual life plan. Now let's talk about the number almost every retiree has heard, 4%. The 4% rule can be useful as a starting point, but it should never become a psychological ceiling. It was developed to study how a portfolio might have survived historical retirement periods under specific assumptions. It was not designed to tell every retiree exactly what they should spend every year. Your situation is different. Your age is different. Your portfolio is different. Your Social Security income is different. Your taxes are different. Your spending needs are different. Most importantly, your flexibility is different. That last point matters enormously. Imagine two retirees with the same $1 million portfolio. Retiree A needs $60,000 every year from investments because they have very little guaranteed income. Retiree B has $35,000 of Social Security and pension income and only needs another $25,000 from the portfolio. They have the same portfolio size, but they do not have the same retirement risk. This is why retirement planning should begin with your income floor. Start by calculating the income that is likely to arrive regardless of what the stock market does. For many Americans, that includes Social Security. Some households also have pensions. Then calculate your essential expenses: housing, food, utilities, insurance, transportation, taxes, and other necessities. If your guaranteed income covers most of those expenses, your investment portfolio has a different job. It doesn't have to carry your entire life. It can provide flexibility. That flexibility can fund travel, family support, hobbies, home improvements, charitable giving, or simply a higher quality of life. And this leads to one of the most useful ideas in retirement planning. Separate your essential spending from your discretionary spending. Your essential expenses need reliability. Your discretionary expenses need flexibility. That means you don't necessarily have to treat every dollar of your portfolio as equally untouchable. You can create a core spending plan that protects necessities while allowing optional spending to move with your financial situation. For example, suppose your household needs $50,000 a year for essential expenses and another $20,000 for lifestyle spending. Your goal isn't necessarily to guarantee $70,000 forever. Your goal may be to protect the $50,000 while giving yourself a structured way to enjoy the additional $20,000. That distinction can dramatically reduce anxiety. Now let's address the market, because this is where many retirement plans break down. The biggest danger isn't simply that markets fall. It's that you are forced to sell investments after a major decline to pay for expenses that cannot wait. That sequence of returns risk. A bad market during the first few years of retirement can do more damage than the same bad market later because you're withdrawing money while the portfolio is falling. One way to manage that risk is to maintain a dedicated cash or high-quality short-term reserve for near-term spending. The exact amount depends on your circumstances, but the principle is simple. Don't make your entire retirement lifestyle dependent on what the stock market does this month. At the same time, don't make the opposite mistake and hold an enormous amount of cash indefinitely. Cash provides stability, but too much cash can reduce long-term growth and may lose purchasing power to inflation. The goal is not maximum safety. The goal is enough safety to prevent bad decisions. And that brings us to another powerful tool: spending guardrails. Instead of promising yourself that you'll withdraw exactly the same amount every year, establish rules before the market gets emotional. If your portfolio performs strongly and remains comfortably above your target, you might allow yourself additional discretionary spending. If markets fall significantly, you could temporarily delay a major purchase or reduce optional withdrawals. Notice what this does. You are not predicting the market. You are creating a decision-making system that tells you what to do when conditions change. That's far more practical than trying to guess whether stocks will rise or fall next year. Taxes are another reason retirement spending deserves more attention than it gets. A traditional 401k or IRA can look like a giant pile of money on your statement, but it isn't all yours to spend. Withdrawals can create taxable income, and eventually required minimum distributions can force withdrawals from certain retirement accounts whether you need the money or not. That's why the years between retirement and the beginning of required distributions can be strategically important. Depending on your income, tax bracket, account types, and future expectations, you may have opportunities to manage taxable income more deliberately. That could include deciding when to take Social Security, coordinating withdrawals across different account types, or evaluating whether partial Roth conversions make sense. None of these strategies is automatically right for everyone. The important point is that retirement income should be planned across multiple tax years, not improvise one withdrawal at a time. And there is one more issue that deserves a specific line in your plan: healthcare. Don't let an undefined fear of future medical or long-term care costs turn your entire retirement into a waiting room. Instead, put a number around the risk. Review your Medicare costs, supplemental coverage, potential long-term care expenses, insurance options, and other resources available to you. You may decide to reserve a specific portion of your assets for healthcare. You may choose insurance. You may decide that home equity is part of your backup plan. The strategy will differ from household to household, but the principle is universal. A risk you have identified can be planned for. A risk you refuse to quantify can consume everything. And finally, there's something your spreadsheet cannot calculate perfectly: the value of time. A $10,000 vacation at 65 and the same $10,000 vacation at 85 are financially identical on paper. Your ability to enjoy them may not be. That doesn't mean you should spend recklessly when you're young or try to reach zero. It means your retirement plan should recognize that money has different value depending on when you use it. So here's a simple framework you can actually use. First, calculate your annual essential expenses. Second, identify your reliable income sources and determine what portion of those expenses they cover. Third, divide the rest of your spending into flexible categories. Fourth, create a cash and investment strategy designed to handle market downturns without forcing panic selling. Fifth, review your tax strategy before required distributions become the main driver of your withdrawals. And sixth, create a specific plan for healthcare and other major risks. Then put one final category into the budget that many retirees forget: enjoyment. Not whatever is left over, an actual amount. Travel, family, hobbies, experiences, giving. The things you spent decades working toward. Because retirement planning isn't about maximizing the number printed on your account statement. It's about maximizing the value that money can create for you while protecting the future you still need to fund. You already learned how to save. Now you need to learn how to turn savings into a life. If this video gave you a different perspective on retirement spending, hit the like button, subscribe for more practical retirement and personal finance content, and leave a comment below. What is the one thing you've been saving for that you actually want to enjoy in retirement? Thanks for watching, and I'll see you in the next one.